All right, everyone. How are we doing today? So I see a regular crowd. Welcome, Tom, Alfred, Aditya, Arun, Barbara. Hey, Jay. Hey, Matt. See a new name, Kuchipuris.
Hey, hi.
Hey,
Yeah,
how are you
I
doing?
joined. This is
Is
my
it the
first
first
time.
time, or did I miss in previous meetings?
No, this is actually my first time. So yeah, I am a beginner. I wanted to start somewhere and I thought this is it. So
Oh, yeah, we have folks at all level. Uh, Feel free to ask questions. I'll go through in terms of what I learned this week, what I'm seeing in the market this week. Doesn't really matter from a long-term investing perspective, but it's good to know where we stand. We don't know where the markets will go, but it's good to know where we are.
sounds good.
And then we break out into different breakout rooms and have a deeper discussion on individual topics if folks want to do that.
Okay, sounds good.
Cool. Anyone else here for the first time? Rest I see names familiar. Nitesh, Niyanka, welcome. Pishang, Pushkin, Sri, Thai. Okay, looks like regular crowd. Uh, I don't know, something happened on Zoom when I logged into my Zoom account. It didn't show me the list of the meeting. So I'm like, how do I even start the meeting? I actually went on to Meetup and got the link from there, which was like very unusual. I'm like, what? What happened to Zoom suddenly? Anyway, glad that it's working and we are back on schedule. Morris says first time this year. Yeah, you don't get the benefit of being newbie, Morris. You've been here for many years, so no benefit of that. Hey, I'm new to this place, so give me some benefit of doubt. No, you're not gonna get that. Who else? What else is happening? Anything new? Any observations? We'll get started. I just want to, give a couple of minutes for some other folks to join in. Any new thing you tried this week? Nope. Pretty regular week this, huh?
Um, Vivek,
Yeah, Sam.
there was a ZDNet.com article about AI courses. So I began a generative AI course on Google, but it's pretty boring.
Baby, that there are a lot of it, I get so many ads of AI generated advertisements for AI courses. I
Do
mean, you
you
gotta
have
be
any
careful.
suggestions?
Sorry?
Any suggestions? Because this Google is pretty boring.
Uh, I don't have. In fact, I was in one of a AI meetup on Thursday, and I was talking to some other folks. Some of them also wanted to vibe code. And now I'm looking at your name, Aditya, and I told, you know what, I also in 2026, I have on my list to do something using Replit.
Right,
So I
right.
told them, like, I did do it in 2025, but in 2026, I have a target to build something using Replit, so I'll try it.
Yeah.
But folks have tried, I think someone was saying they've been using Claude Code. And of course, over the last, I think it was the last week, um, even journalists are
Yeah.
creating apps using Cloud Code and
Yeah.
Cloud Works. And I was like, come on, if CNBC journalists and Bloomberg journalists can spend a weekend and create an app, I think I can do better. I just need to get that motivation and a push and spend a few
Exactly. Very good. And
hours.
and I just created a couple of agents recently, and they're actually useful.
Yeah.
So and the interesting thing is, like, you can now, I mean, code agents just in plain English, and so even that, um, so yeah, and then you can define how they interact with each other. So it is changing for sure, and some of it can be useful, and yeah.
And
especially in our investing space.
oh, absolutely. And yesterday I was this is like a fourth Friday of a month, and I go to a startup pitch event. I'm one of the judges. So there was in fact, now we are seeing some of the startups who are focusing on making it easier, not just to code, but also, to deploy or to manage the whole orchestration of running your agent. So it's like I don't have to deal with MCP servers. I can just go. There was one startup which pitched in terms of standardizing MCP servers. I don't really have to deal with it. And if the protocol changes because it's so nascent, it's so new, the whole MCP protocol, I don't want to be the one who will go and now modify my code and all that. If I use their services, they'll take care of all of those stuff. Life is changing very fast, and yeah, as an investor, we just got to be on a lookout. But
Yeah.
but
And
but I will do something in 2026. I just need to find enough motivation to do it.
I just want to share, like, there's this thing called Lean. A lot of organizations are starting to adopt it, and I'm already seeing, the fact how different LLM models have already been commoditized. So, for example, ChatGPT is down, you just go to Gemini or whatever. That's what individual people are doing. But using these sort of third party things, now in the back end, I can choose if I've created an agent. I just get a drop down and I can say, okay, now use ChatGPT as an LLM or use Claude's most recent model as an LLM. And yeah, so
So
just want to
so
share
so
that.
that remind me, since 2025, I've been saying over the few years, these LLM will become commodities. So
And it's
value
here, so it's done.
value is will not be in terms of creating your base models. Value will be in through the distribution channels,
Yeah,
right? So don't write off Apple just yet because they haven't come up with a base model. 4 years later, you might think Apple did the right thing by not investing billions and tens of billions of dollars, by not investing in base LLM models because they have been commoditized anyway,
yeah,
right? So different one. But we talked about Glean. So I mean, in my previous company when I last worked, 2023, we had used Glean, but I'm assuming now the product. We used to love that product even at that time, but now they would have infused it with all LLMs, etc., to make it even more usable. In fact, I was talking to the founder C of Glean. We met at a social function. He's a relative of my very close friend. So my friend had his 25th marriage anniversary. So Arvind Jain, who's the founder CEO of Glean, he was also there. We just got up some conversations
nice.
in the social circle. So pretty nice guy. There it is. So Nitesh is asking any recommendations to learn about startup funding, term sheet, cap table for first time founders. There is a book called, I think, Startup Investing from Jason Calacanicas. Hope, hopefully I'm not mispronouncing his name. He's known for basically, he got his chops by investing early. He was a scout for Sequoia and found Uber for Sequoia. Sequoia gave him 25,000 shares of Uber, and that time the Uber valuation was maybe $15 million. And out of, so not 25,000 shares, $25,000 worth of shares. So that $25,000 worth became 100 million. But please remember, for one Uber, there are 99 who never saw the light of the day. But he has a book on startup investing. He also runs, I think, a university for founders, first-time founders. So just explore this. But you can find, some books on understanding the valuation cap table terms, liquidation preferences, so on and so forth. Okay, Shri says Europe is worried the US could block access to his tech. How big of a problem would that be? US could block access to his tech, then the US companies will also be in trouble. And if Europe retaliates and we don't get ASML's machines, then we are toast anyway. So I don't think these things will. I don't think we are out there to kill each other. These fears are similar to, hey, I got a nuclear bomb, the other country got a nuclear bomb. What if we bomb each other? probably we're not at that reach that level of stupidity that we need to worry about it. But if Europe develops, I mean, and I do know that some of the countries have started to develop their own versions of, let's say, Google or Twitter, etc. But then we'll become too fragmented. We'll lose the value. So I'm not too much worried about that. Not just yet. What else? So what are we gonna talk about today? Let me share my screen. Before that, anything else? Cool, we can get started. Any last call for any other first timers here? No. All right, so let's get started, guys. And when I'm on that startup event, it's like everyone, and I meet up with the founders, of course, and then also there are some investors, and everyone is like, want to be an angel investor, whether they know anything about investing or not. But the question is, it's considered to be, looks so sexy on your resume that, hey, how do I get into angel investing? I mean, that's the first question which people ask. How do you get into angel investing? And then they are shocked that I told them I don't do angel investing, not yet. I'll do angel investing when I have a capital to deploy in 50 companies, right? Based on how much is the success rate and all that stuff. And we have a least information. But I have founders in thinking about as a business, right? Tech is not enough. It has to be a business if you really want to survive. Anyway, so hopefully you're seeing the right screen. Are you seeing Zoom or are you seeing a document with today's topics?
We're seeing the document.
Cool. Kochiburi asks, are we in AI bubble? When will that burst? How to be safe? Great. You read my mind. We're going to talk about a couple of perspectives on is the market in bubble. I'm not going to talk about specifically on AI, but overall, is the market in bubble? I spent some time on listening to a couple of investors who probably know a lot more than I do. And then I looked at in terms of bringing into a perspective so that you can make your own judicious decision on whether the market is in bubble or not. Barbara is asking, would appreciate your take on gold and silver if should shave off some gains in mining stock or just take a hit with taxes. I'll share some charts. Uh, uh, Overall, I think we'll get to that once I have those gold and silver charts. Probably we'll talk about it. What else? Cool. These are the only two questions to start with. Okay, pretty good week. We had a pretty good week anyway. Vishal is saying big tech earnings next week. Are we seeing top on tech? We only know that it was top after we have rolled down from the top. Nobody knows are we on top on tech. But Max 7, if you're worried about Max 7, I think 4 companies out of Max 7 even trailed S&P 500 in 2025. Even though we talk about, oh, it's all big tech are running the market, they're controlling the market. 4 out of 7 underperformed the market. So, which probably will be surprising. Microsoft, Amazon, I think Google outperformed, Nvidia outperformed, Tesla, was it 3 or was it 4th one? I'm missing out which else underperformed. But we'll see. In terms of earnings, it's only earnings will tell. But hold on your questions around top and or bubble. Once we go through those two perspectives, probably you'll get a little more clarity on that one. Okay. All right, so we're gonna talk about perspectives on market bubble. Start discussion with some thoughts around investing. Some thoughts for our mind, food for our mind. Also want to talk about a startup exit that happened this week. It was a Brex, a company that Oh, it was a fintech, but basically help corporates in terms of getting credit cards for their employees and then expense management stuff like that. That got bought over by Capital One. So if you're an investor in Capital One, you should know that they did an acquisition this week, and we're gonna talk a little bit about that because my timeline was lit up in terms of, oh, did they make money? Did they not? Did employees, got the short end of the stake? What happened to the investors? So on and so forth. Uh, yeah, that's and then general quick look at the macros and all that stuff. All right, as always, everything we discuss here is only for education, so don't go and trade. Don't go and buy a stock saying, hey, you know what, Vivek talked about it. Or someone else talked about it in this meeting. Do your own due diligence. You are the best judge of what might work for you and what should not work for you. Stuff that worked for me may not work for you. Okay, so let's start. Nitesh is asking any recommended ETF to invest in private equity like SpaceX, OpenAI. I think ARK Invest has something for these ventures. ARKV. Let me just search for it. Kathy Woods has something. ARK Venture Fund. ARKVX. Right, so let's see what it has. ARKVX. Oops. Maybe it's tilde. Let's go to the ARK website. ETFDB doesn't have that info. Come on. So what are the holdings? They got what? This ARKVX? What are we talking about? ARKX. No. ARKVX. ARKVX. Okay, ARK Venture Fund. Let's see its holdings. So that's got a SpaceX, XAI, Figure, Zipline. Yeah, that could be one way to invest. There are other which are you can invest into SPVs, but then there are a lot of SPVs being floated. My CPA floated one SPV and has been sending emails saying, hey, we are opening up for investment in SpaceX or XAI, stuff like that. But these will be pretty expensive way to get in because we don't know what pricing are we going to get these and things like that. So, but this is a way to invest. And if you don't really want to pick up one particular company, ARKVX could be a vehicle.
Vivek.
Just one second. On the other options, I talked about SPVs or other thing is you need to have a big money and know some big money managers who generally get access to these and then they talk to their clients and give them options, allow them to invest. But now we have ARKVX and I think there are some similar, you may be able to find some similar funds who will give you access to some of these private companies. It's blown out of proportion right now. Yeah, go ahead, Sam.
Now that Canada's open to China EVs, what companies should we hurry up and buy? I didn't buy XFang and I haven't bought BYD yet.
So just that China has opened for
Canada.
Sorry, just that Canada has opened its market for Chinese EV. How big is the Canadian automobile market? I don't think that's one of the biggest market in the world.
Well, Canada's about a quarter of the size of larger than California.
Yeah,
30
so
million.
it's not a huge market. Anyway, I mean they have only what 1.9 million vehicles. I'm just looking right now. 1.9 million vehicles, new vehicles sold in 2025. But if you really want to get an exposure, the reason why I have some exposure to these Chinese EV companies is because they are also capturing the market in Europe, in Australia, New Zealand, Xpeng have opened offices there. Neo has started selling in European countries, and then BYD is all over the place. Anyway, they are in Latin America, they are in Europe, they are in cars and the buses and everything else, and they have one of the best technologies as well as the cheapest in the EV segment. Just because they are coming to Canada probably is not going to change my decision in terms of that I would want to ramp up my position in that, because at the end of the day, we still have the same risk of it's a Chinese company listed and trade mostly in China. You don't have any operational control on that, and these all are being traded in US through um, variable interest entities, which China could shut
Same
down
with
any
Hong
time.
Kong. Hong Kong is VIR too. No
Yeah,
one
so
owns anything of
yeah, so
China.
VIE is not a, it's not, it's it's something that when China told that you cannot raise cap, you cannot sell your shares to foreign investors. These companies started creating VIEs and started giving the shares of VIEs to investors, right? And China's government has kept mum on this one, but any point of a time they can come and say, hey, you know, these things we were doing, these are illegal. And of course there are, if you're investing in any Chinese company, it means CCP is in the boardroom, and you have to be comfortable with that. I am not comfortable with that, so I'm not going to increase my position on overall portfolio position with respect to China. But they coming to Canada is not going to change my decision. It's not that big a market. Okay,
No, thank you.
cool. All right. So the first one, company versus stock, I want to talk about is one of you reached out to me and say, hey, what do you think about this X company? And I'll reveal what the company is, because they say, hey, I'm a new investor, and then I've invested in this X company, which is Microsoft, and the stock has gone down. What do you think about it? So I thought I will answer this question, but may not be exactly in a way that in which you were expecting. But I think there's a question behind the question which I want to answer. First, if you are a new investor, then Shri, I'll get back to you. If you are a new investor, then and you really haven't figured out how to analyze the companies, etc., what business did you have to buy an individual stock? Right? Was it because you heard about the company? Was it because your friend invested in it? Was it because you heard it in on CNBC, etc.? Right? None of them are the right reasons to invest in a company, right? You could still get access to, you could still buy an ETF and get access to the company. So first is that. Number two is any answer that I give about the company or the stock is not going to satisfy you. The reason is, let's say if I tell her this company is great, the stock is challenged, and probably the stock will come back up. We never know what could happen in 1 year or 2 year. I've seen great companies doing nothing for 10 years. Right? Microsoft had a lost decade. It was still a good business, but it also has a lost decade. Apple didn't do anything for first 20 years. If you bought Apple and held it for 20 years, probably didn't make any money, right? So me giving you any answer on, what in terms of the company is great, the stock will recover, is not going to satisfy. If a stock doesn't recover, you say, oh, come on, he told me that stock will recover, and I'm left holding the bag, or stock didn't do anything, right? So, and let's say a stock, if a stock does recover, that also could be maybe because of some short-term tailwinds behind it. So there's never a great answer to any short-term related questions. But I will look into and give you my thoughts on where the company is and where the business is. So I'm looking at, the company was Microsoft. I looked at year to year basis. Microsoft looks pretty good. If you look at 5-year CAGR, growing their revenue by 15%, growing their net income by 18%, 20%, good return on invested capital, way more than probably their cost of capital, and also giving you some dividends, and has got a moat around its current business, which is, they are so big on enterprise. but the stock has not performed. This is one of another Max 7 which has underperformed S&P 500 last year. And if you really look at Microsoft, the shares probably are. Now let me close this one. Yeah, over what this is 1 year. I'm looking at maybe this is 1 year. Yeah, 1 year. It's done only what 4%, right? If you had invested in QQQ, you probably would have made close to 17%. Right? So last 1 year it hasn't worked out, but that's nothing to say from a business perspective. Right now, the market is concerned about this lot of a capex, which Microsoft has done in terms of the commitments that they have made for investing in AI, the questions that have been hanging over it, and including the others like Meta, is are we going to see money from these huge commitments that they have made? Number two, additional factor which I feel is hanging over the head of Microsoft is their investment in open AI, right? We still know that there is an issues around the whole governance aspect of open AI and profitable, is it for profit, non-profit? There are court case going on this particular topic, so market is a little jittery about it, right? But could in 2026 could we see a reversal of it? Who knows? It's in short term, market runs on sentiments. If we get some wind of, I think this AI investments will work out, the stock will go higher. Look at what happened to Intel, right? A lot of AI tailwinds, or government is behind it. Now SoftBank invested in it, Nvidia invested in it, and the Intel stock was like through the roof. Now after earnings, it has crashed like 17% in a day. Short term, a lot of stuff runs on mood and the momentum. Long term, it's the business fundamentals that will justify. And over a long term, I've seen, Microsoft from a business perspective have done fine. Now the question is, if you are not interested or don't want to follow every earnings of Microsoft, look at what the CEO has to say, and don't want to have the risk wherein like one earnings the stock could be down 10%, then maybe just pick an ETF, pick QQQ, spread your bets. Right? There is, you'll have to build your own conviction. We put it that way. I can say whatever I want to say about Microsoft, but the stock goes down 10-15%, you'll be running through the door saying, oh gosh, I made a mistake. While I may be buying the stock when the stock goes down, share price goes down 10-15%, I'll be very happy that I got to buy it at a cheaper price, because maybe I built my conviction, but you haven't built your conviction. We'll be taking two separate actions on the same stock on the same day. So the idea is build your conviction, and if you cannot follow the company, ETF is a great way to invest. I mean, QQQ has done pretty nice. And let's say if I'm looking at 3 year per week, 3 year Microsoft has outperformed, but QQQ also done like 6%, 600%. This is 10 years, not 3 years. I'm like, what? 3 years one day, QQQ has outperformed Microsoft. Hopefully you got my answer. May not be the one that you were looking for, but I guess I want to hammer this point that if you don't have a way to build your own conviction, you will not be able to stay with the stock for a long term to enjoy those multi-bagger gains. Right? If you just bought the stock because you heard in this meeting or on some other podcast, or you met someone else, but you didn't put in your sweat and blood in analyzing the company, it is very difficult to build conviction without that effort. It is easy to borrow ideas. It is almost impossible to borrow conviction. Go ahead, Sri. You have a question?
Yeah. Going back to the ARC venture fund, it's a closed-end fund, and I don't see any trades on that one on the Thinkorswim platform. The other point that I wanted to make was the annual fund expenses is 3.5, almost 3.5%.
There's a cost. That's why they are all trying to get retail investors, because these are very costly funds, even SPVs or any of these funds. So yeah, if you want to invest in it, I want to put small money, sure. I'm not the one who want to invest in any pre-IPO company, not just yet. This is like a venture investment, right?
How do you invest in this one? When it is not traded on Thinkorswim, it does not give me any trades.
Okay. Oh, so this is closed-end fund. So I don't know, maybe we'll have to find some other fund then. But I knew that ARK created, then it can't be an ETF. If it is an ETF, then it has to be tradable. Or then it's not, doesn't classify it technically as an ETF. I don't know. You'll have to look at it. I've never looked into these or any others, but there are ways to invest in it. Or if you want to get the secondary shares, there are secondary markets that exist in which you can go and buy the shares from the existing employees who are selling it. But there are now ways to get exposure to pre-IPO companies. Okay.
Thank you.
Cool. All right. Other thing which I wanted to discuss before we get on to the real meat is around. I was reading through Howard Marks, one of the old means probably October or December 2025 memo, and I really like this matrix that he put up in that memo, which basically talks about either your ability or your portfolio ability to take risk, and you as an investor, your willingness to take risk. So there are two different things. One is ability, another thing is willingness, right? So I may be extremely willing to do certain things, but I have a zero ability to do it, then it doesn't work out for me. So if you are creating your portfolio and you're trying to figure out, maybe I want to buy these stocks, probably risky, but a lot of growth, a lot of these new tech growth stocks are also very risky stocks, because you never know when they can go down to zero. We have seen 2021 what happened to a lot of those companies, right? So you need to understand how, when you're structuring your portfolio, in terms of, does your portfolio has ability to withstand that risk, and then think about, are you willing to take that risk? And then you categorize, so at these two axes you can categorize your portfolio as, is it a protective portfolio, is it defensive, or is it like a stupid naive, it's a naive portfolio, or am I capitalizing on it? So I just want to give you some thoughts around, if the investor or your portfolio has a high financial ability to bear risk. For example, hey, it's only my 20% of net worth is invested in the stock market, because rest, I have T-bills, I have cash in the bank, I have rest very secured investment. So whatever I'm trying to invest to the stock market, yeah, I have a high ability to bear risk. Right? Now the question is, if you have a high ability to bear risk and you have a willingness to bear that risk, because now you have an opportunity to make a lot more money, then it's called as a capitalizing on it, right? You're capitalizing your portfolio for higher returns. On the other hand, if you have your portfolio is not set up to bear risk, because maybe my portfolio is already 90% tech portfolio. Maybe my portfolio has got a lot of growth companies. Maybe 40% of my portfolio is invested in ARKK, a lot of growth, but it's also very risky, right? If you have invested, or if you've gone all in ARKK, you may not be able to survive the downturn of 2022. But you had a great year in 2021. Maybe, and then afterwards, it's been growing great. But then you won't be able to survive those drawdowns, which are necessary to survive if you want to really enjoy those long-term gains. So, but if the portfolio has a low ability to bear risk, but then you're also not willing to take risk, then it's considered as a defensive, because I know how I'm trading. I'm not going out of taking stupid risk because I know that my portfolio can't bear the risk. But if you have a if you have a high ability to bear risk but you don't want to, then you become defensive. But if you have a low ability to bear risk and a no willingness, then you are just protecting your existing portfolio, right? It's okay that I won't make money. It's in I have a limited amount of returns, but I don't think my portfolio can withstand this volatility, nor that I will be able to sleep well if the volatility comes in, right? So I have a lower willingness, and my portfolio is also not structured in a way that it can take this volatility. Then it means I'm a protective investor. The worst which I see among investor community is low ability to bear risk but high willingness. Right? New investors, young investors coming and say, I want to become an angel investor. Okay, how much money you have? Do you want to invest? 50K. Okay, how big is your overall portfolio? 50K. That's something which, and do you have any other investments? No, I'm just starting my investing life. That's where I want to tell them, come on, take a deep breath, take a step back, and go and analyze why you want to do this, why you want to bear this risk. Well, that smells of foolishness, or call it in a better, more friendly terms, naivety. So if you are looking to buy some stocks on which you don't know how this will perform, these are new tech, never proven, I'm not saying that you should not buy it. We'll run through this criteria of what other things are you holding in your portfolio. Is your portfolio structured to take that risk? Some love doing this barbell approach, right? I'm gonna have a lot of stuff which is quite safe, and then I'm gonna go to the other end of the barbell and pick up the stocks which are very risky. Well, that's okay, because you know that your portfolio has ability to bear the risk because you have a lot of assets which are pretty safe. But if you do not have a safe portfolio, but you have a high willingness to take that risk, it's only a matter of time. One bad step can kill you. It's like I want to climb the rock, but I'm without a harness. Right? I want to go rock climbing without harness because I'm so enthusiastic about it, but I have no harness around it. And yeah, maybe I'll lucky my hand won't slip, but you know what will happen if at one point of a time I slip? It's game over. And when it comes to investing, I think the only differentiation that you can have between the great investors and equally sharp but investors who lost their money is ability to survive through bad years, ability to survive through those downturns that you will have in market, which you will always have in the market. It is the cost of playing in the market. Volatility is the price that we pay for getting these above average gains. Otherwise, get a T-bill, invest in S-Gov, invest in T-bills, enjoy 4% while it lasts. But if you want to enjoy, last year we got what, 16%, including dividends, 17.7%. Prior to that, we got 24%. Prior to that, we got 26%. But if you want to enjoy these above average gains, you will have to go through drawdowns of 2022, where we had 18% drawdown. Right? So anytime you are getting a lot of excited about investing in something that, my God, this is going to be the best thing after sliced bread, think about how you're constructed your portfolio, think about the willingness and ability. A lot of people only focus on willingness without focusing on the ability of their portfolio. Okay. I found it really interesting. I thought I'll share with you guys. All right, you do what you want to do. Okay, let's look at some other stuff. So what happened in this week? I think we talked about taco trade. Was it this last week, our meeting, or maybe some other meeting? And I'm like, that, you know, we saw the same thing this week. Taco trade is still on. We had all the bruja over the Greenland. S&P had 2% crash. S&P had I think the biggest drawdown since the Liberation Day in one day. And then a couple of days later, yeah, everything is fine. Life is good. But during that tantrum, we saw a sell-off in US equities. We saw sell-off on US bonds. We saw sell-off in terms of a dollar also started to sell off. So everything related to US was down. This was like, okay, sell the US narrative was prevalent. And then once the taco stuff happened and markets were back to green. Right? Again, I love this. For those who do not know taco, it's Trump always chicken out. I don't know which financial media coined the term, but it has now stuck with me, and I think it also stuck in the at least on the financial media. They will talk about taco trades. So we got another chance for a taco trade, and I love our president, which creates some volatility because that allows us to sell a premium. And you know, when the vol crush happens, those trades all become profitable. So and we saw this volatility in 2025. Now it's back to creating the same stuff, same level of volatility again, which I love. But the question is it pushing too far? Because now we also saw today morning, looks like, Sam, you were talking about Canada made a deal with China to allow EV companies to sell cars in China. And now DJT is talking about if Canada makes a deal with China, we will hit with 100% tariffs. So we will see now how it opens on Monday. Is it another taco trade? Only time will tell. But I think, you know, you can do only maybe once in a while. We already did it twice in 2 years. If you go and start threatening all our allies, you know, the rest of the world and the rest of the countries are not stupid. They will start to look at alternatives, you know, and build other markets or want to invest in other countries as well. So we have not seen a large scale sell off on US treasuries just yet, but what we have also seen is the foreign countries are not buying the treasuries at the same pace at which they have been buying earlier. So they have slowed down in terms of the pace of buying treasuries and want to diversify their reserves outside of US treasuries. That's one reason why gold has gone up so much. Whole of 2024, 2025, central banks have been buying gold. Now, gold is 25% of world's central bank reserves. It is still less than US treasuries, but it has become 25%. It has grown a lot over the last 2-3 years. There was some chart, I think Financial Times had put a chart. I forgot to take the screenshot, but that's one reason why the gold has gone up so high. And if we continue with these tantrums and behave like, you know, a 2-year-old kid, this rally may continue on long term. Now, could it be overextended in the short term? We'll look at the chart and say, looks scary to me, especially the silver. But at a more macro level or a secular stuff, companies want to diversify, which also shows up in terms of the equity inflow into different countries. took a screen from Bloomberg. US only got maybe 2% of all the equity inflows in so far into 2026. One reason could be because in 2025, other markets ex-US has done much better. So that could be one reason, but the other could also be, gosh, I don't know. We still have another 2.5 years of this president. We don't know what else could happen in this one. So I do want to diversify my portfolio a little bit outside of US. I already have started diversifying. I'm adding a little more. And maybe the institutions also want to do the same stuff. Right? So it's a international stocks that have been dominating any new equity flow. Overall, US market, we have enjoyed the top position. We are what, 4% of world's population, 26% of world GDP, but we are 70% of world stock market. Why? Because everyone want to come and invest in US. All the like 70% of the total world's market cap is US exchanges. And also, I think almost 70% of the investments that are happening used to happen in US. It's not going to change in a year, but if we do not, control our behavior, things will start to change. So that's another macro wind around why we are seeing, countries trying to diversify, why we are seeing that emerging markets have done better, why we are seeing companies like Europe has done better. Europe exchanges have done much better than US. Like EFA, which is developed markets except ex-US, that was like almost twice of S&P 500 in 2025. Right? So it might pay for us to look at our portfolio and say, maybe I want to diversify. This story didn't work out for last 15 years. Investing in outside of the US was always an issue. Because US was always outperforming it. Maybe there's a structurally we are changing now. Who knows? It's always pays to maybe have, diversification, not just from sectoral perspective, but also from geographical perspective. Okay. So, but coming back to US, we had some data that got released this week in terms of initial unemployment claims coming at a lower levels. Consumer confidence is at 5-month high. Spending data point to another impressive gain. So the fundamentals looks okay. Just from a US perspective, our fundamentals are still strong. I think our GDP grew by 4%. I forgot to put that, which is crazy numbers. Now you can believe or discard these numbers as you may deem fit. Some might say, oh, come on, these are government first data. This is the data that I've been working with. So I will just stick to the data and assume these are correct. But we had some pretty decent macro numbers coming out this week. Right? And then we also have a Fed meeting this week. I don't think we're going to get any rate cut. Market is not pricing in any rate cut. But what market may want to look for during this week is what's the Fed, giving us a hint about where the inflation will go, where the interest rates might move. And, probably will be nitpicking on every pause, any punctuations, any alliterations, the modulation of the voice of Jerome Powell to try to extract some intelligence. I don't know why market does it, but it always do that. Other thing that you notice in market, small caps, Russell 2000 hit all-time high. This is another area where we're seeing that the rotation has started to happen. Right? Magnificent Seven actually year to date is negative for 2026. Even though S&P is close to 1.2%, this is emerging market is up 6.5%. Japanese market Nikkei is like up 7% and Russell is like 7.5%. So we are seeing that the rotation is happening even with the US market. And I think this is what, eighth or ninth week in which Russell has outperformed S&P. And this shit hasn't happened since 1998 or some 2000. There's some crazy metrics around it. That this continual outperformance of Russell against the S&P hasn't happened for decades. So there may be it may be sustainable. Also, we are now looking at rate cuts this year, at least two. That also bode well for a lot of companies which are in Russell 2000. So the Tom Lee's rally of that Russell 2000 will outperform. He was early in his prediction. He was maybe 2 years early, but when it comes to investing, being early as is equivalent to being wrong. So remember, I think in 2023 or in 2024, he mentioned that Russell will be up 50% for the year, and it actually underperformed S&P. But now finally, Russell is outperforming. Again, I have no idea where it will go. I don't think even Tom knows about it. But we are seeing some rotations here. What else? The metals keep on shining. So at silver is now above $100 per ounce. Now look at this chart. This looks scary to me. Right? Almost did nothing from 2011 all the way to 2025. 14 years did nothing, and now like more than double in less than a year. It does look scary to me. And if you are holding it at this point of time, then I think you're just praying that this rally will continue. In fact, I also saw some other stat from Bloomberg analyst in terms of the amount of dollars that have gone in capital inflow into silver ETFs. That hasn't increased as much as the price has increased. Right? So it's not that a lot of folks are actually buying those ETFs or taking positions into silver. Maybe the market is thin. I don't know what's causing this. And I'm not don't focus much on the commodities and the metals. But this does look a little scary to me. And the fact that the overall the amount of dollars have reduced, but the stock price has continued to go high. Maybe fewer traders are causing this volatility. And when this reverses, is going to reverse at the same intensity. So if you're holding this, you need to know when to get out. Or we've heard of a term of dollar cost averaging while buying. Maybe do dollar cost selling. You may want to decide, okay, maybe I'll sell a little bit every week. Figure out what works. But to me, it looks unsustainable. Again, I don't have any idea around where this will go or what's causing this. There are some. I heard some of those metal traders talking about some COMEX, some ban on this physical silver, something around China. But I have no idea. Similarly, gold is now nearing 5,000. I know at least a little bit around, the central banks have been pushing gold, and that's why it is going up. But whether it will continue to run on the same pace is what you have to decide. I understand there are structural secular tailwinds behind getting into assets other than US treasuries for central banks to hold on. So maybe over a long term, it's a good trade, but I don't know, in a short term, looks to be risky to me. But I have no idea where the market will go. So I just wanted to share this couple of charts from a long-term really perspective, if you look at it, seems to be very overextended to me.
How? So, Vivek bhai, how do you judge it? Because, like, and maybe we should talk about them separately. So, starting with silver, and these are all inklings I hear. I don't know how much can they be justified. One, its newfound applications in EV batteries and data centers, and then it's the secondary use case being its use as a store of value, similar to whatever Bitcoin, and as an alternate to US dollar. So maybe, yeah, let's talk about that one first.
Yeah, Bitcoin's hasn't performed. It was down
Right.
6% for 2025, and it's been down, I think, and I have some funny image for Bitcoin. I'll show you guys later. But I have seen investors slash trader getting excited about, hey, new use for this in a particular industry. We saw this around copper in 2021 when they said, oh, we got for copper electrification we'll need because we got a lot of EVs, we need to build on all those chargers, and hence copper will be required. And then it died down. Now copper is back into the game because now, oh, we need to have those electricity demand. Now is this time not for EV charging facilities, but this time for data centers. The question and the challenge always is, how much have this been priced in, right? If you're already pricing in of, like, say, next 5 years of all the growth, then getting it that point of a time doesn't help you. And so, and it's little more art than science. I'm not chasing any of these rallies. And I think I made a mistake. If you guys remember, was it 2024 maybe, or was it early 2025? There was an article in Barron's. And I shared that article. We got through the article that if you miss the gold train, silver may be the next. But I generally don't invest in silver. Gosh, I should have acted on that one. But they did talk about it, that silver has been sitting quiet for such a long time. I think maybe it was 2024. I don't know. And there was a whole article around, if you think you missed the gold train, maybe hop onto silver train. But these if you really want to look at it, and maybe look at those companies, let's say mining companies, have they been more profitable, or that's the only way we can judge if those companies who deal in it have been able to do better as a business and then justify it. Otherwise, the commodities themselves don't generate anything.
Yeah, I think the whole, so and maybe, so if we talk about gold then, because I was listening to this thing by Ray Dalio, and he was effectively trying to say, oh, as per, so he's got, he's a macroeconomic investor, and with the world order changing, and how gold's the fundamental sort of definition of money. What he was saying was most fiat currencies depreciate over time, and over the last year, gold hasn't appreciated about whatever 70-80%. The stock market, the value of your money actually is down by, if you invested in S&P 500, it's down by about 40%, whatever. I mean, the numbers are all approximate.
Yeah.
So yeah, it's an interesting take. I understand. I mean, yes.
But Ray Dalio has been, beating this drum for now 5-6 years. If you read his book, I think the book is called Changing World Order.
Yes.
In which he talked about it, and he's been talking about it since, I guess, 2020. One day they will be right, but the idea is we don't know whether such an abrupt rise is justified or not. So right now it's, as I would say, half gamble and half some of the base reasons of, hey, other countries want to hold gold, like Kuchipudi mentioned. We don't have much silver, and then we want to buy silver because now we are finding industrial usage of silver, and other countries are saying no, they're not going to give us silver to us. Well, let's say what happens if suddenly we find a big silver mine somewhere, right? It does happen. and then we'll see that these things correct. Again, I don't follow metals very closely, so I could be 100% wrong, but just looking at the charts will give me a little scare. All right, let me look at some comments. Do you invest in India market? What funds to look at? I only invest in India market through INDA. There are a few ETFs that are available. I think SMIN is another ETF. This is a list of India ETFs I looked at a while ago. And then I decided to take my exposure to India market by ETF INDA. But the bid ask spread on these are becoming wider, so it's difficult to trade options on it, but it is what it is. That's my vehicle to uh, get exposure to Indian market. Barbara is asking, do you have any thoughts on international foreign ETF, both large cap and small cap? There are many international ETFs. Let's say if you want to do a specific country, there are country specific ETFs. I can share the list. There are, if you want to do, I just want to do emerging markets. There's an emerging market ETF, EEM. That's the biggest one. Then if you want to do, let's say, developed markets, but I want to not include US, then EFA is the ETF that invest in the companies from the developed markets, but ex-US. Right? If you want to look at, irrespective whether it's developed or developing, like completely ex-US, I think Vanguard has got a fund. I think VXUS. So there are many ETFs available, country specific ETFs or at a theme specific ETFs, and you can take exposure through those. There is a European defense ETF which I have on my list, EUAD. I've not taken exposure to it, but yeah, even that is there. There are more ETFs than the individual stocks because once you have individual stocks, then you can combine in different permutations and come up with an ETFs. Okay, Vishal, do you have a set template for identify growth stocks which are turning around? Can you please explain your process? How did I pick Jumia? So Jumia I picked up 2020, maybe 2019, I don't know. I was hunting. It came out of frustration that I was late in investing in Amazon. Let me put it that way. First of all, I wasn't even in US when the whole dot-com was happening. And then I started investing in US. I was like, oh, Amazon is super expensive. I'm talking about pre-split. I saw it go from a pre-split of 600 all the way to 1600. Then I pulled a plug on Amazon. Okay, let me buy it. Right. And then, of course, then it split and all that stuff. So I was like, I'm late on Amazon. But long term looks like still done fine. But then I started looking at what are the other companies across the world, because this is a secular theme that e-commerce will grow. And I said, if some of those companies also trade on US exchanges, I do want to have exposure to it. I heard about Mercado Libre in one of a podcast in 2018, 19, and I bought my first share at $350, right? And I've been shareholder since then. And of course, I review it, increase my positions on it. And then I started looking at, okay, what else? And in Africa, I found, okay, there is a company called Jumia. It went IPO on US market, I think 2020, 2019, somewhere like that. So, okay, I put out on my radar and I bought some share. Then I kept on reviewing it, and it has gone through a lot of ups and downs. Looked at what's in the Southeast Asia side, found Coupang was there, then Sea Limited is there. I never pulled plug on Sea Limited in 2021 because it was super expensive, but 2022 gave me good opportunity to start buying that stock at $35. And I still like management, I still like the company, so I held it. So that's all. Then then the rest of the process, I'll look at earnings call. I will see how the business is doing. I'll run it through my criteria. It's okay if they're not making money, but are they operationally doing right things or not? And then I'll put my sentiment on, hey, I'm okay with this, not okay with this, so that I don't want to be emotionally selling a company. And I keep that notes. And when I have to take a decision, I go back and refer to notes on how was I feeling and what was my sentiment for this particular company at this point of a time, right? Irrespective of what the price is, etc. So that's how I keep track of it. And then how do I share, let's say, without sharing too much? For example, this one, right? So since I talked about Jumia, so I've been keeping track of Jumia and my sentiment since 2019. Oh, they IPO'd in 2019, yes. I was unaware of it. Then a bullish 14, then neutral, slightly bearish, neutral, then bearish. And I have a reason why it was a bearish, because they were changing their strategy multiple times. Then, okay, then Q2, Q4 earnings, what they're doing, and now I've not looked at I've not updated this since last year, but right now I'm bullish on this one. Yeah, I mean, the base stuff. Just have to do your research and just follow the stock. So you get an idea, put it on your watch list, and then spend some time, and you like the company, and then start building the position. Right? I get most of my ideas from someone else, right? And then I'll say, okay, let me look into this company. Then if I like it, fine. If I don't like it, I won't take the position. All right, another chart around gold versus platinum versus silver, 1 year percent gains, right? Silver is up 200%. I don't know how long will this continue, but scary charts for me. Another question I see on PayPal with EV to EBITDA at 7, rising EPS, a value trap on can it turn around? So PayPal is in a tough business around whole payments, etc., where there is you have almost no moat. It's a dog eat dog world. For me, it is right now cigar butt investing. Right, this is a classic Ben Graham kind of investing on PayPal. Do I see them growing too much? Probably not. It's not a growth stock until Alex Chris can find some other adjoining business. I think they recently did some acquisition this week on some agentic to agentic commerce, which he's trying. He's trying a lot of new stuff. But only time will tell if those things will work out or not. But for B right now, it's the classic cigar butt investing in which they are cash flow positive. They are buying back their stocks from a valuation multiple perspective pretty cheap, because market thinks that there is no more growth left in it. Right? So it's a classic value investing stock right now. But don't expect any fireworks. I thought some of those new innovations that they've done, the speed at which they have been introducing new features, I'm not seeing that in maybe last 5-6 years. What I've seen in last 2 years. But then those new products / features will need to be tested out in the market. They'll need to generate money. They need to scale that up before it meaningfully starts to impact their financials, right? So you got to be patient on this one. All I can do is I just want to make sure, the big amount of my net worth is not invested in it, because I don't think I see it as a growth company right now. So maybe it is beaten down more than what it deserves. And when it corrects, maybe that gain is what we can get. Cool. All right, let's talk about bubbles. And I'll give you two perspectives on those bubbles from two investors. And then you can decide. I know there are some questions on are we in bubble or not. You can make your own decision whether you're in bubble or not. So first, let's look at the bubble from numbers perspective. Let's look at what happened in 2025. And because numbers do tell us something. Numbers tells us in terms of the past how it is, and does compare with the history to see if we find that is the market in bubblicious territory or not. What happened in 2025? We had 16, and this is all related to S&P 500. We'll also look at the tech little later. Some of these are majority of the content is from slides of Ashwath Damodaran. So he talked about these things in his recent podcast. And then some other slides are from Ruchir Sharma's, right? Those investors are way better investors than I am. So I don't have to, recreate anything. Why not use what's available? So let's talk about it. 2025 was a pretty good year, right? 17% total shareholder returns if you include dividends, 17.7%. And then just from a capital appreciation, it was 16.4%. But it's not that every quarter it went up 4%. Right? The returns are always lumpy. And if you were there, what happened in April, right? We ended 2024 with S&P at 5,880 close to, and in first quarter we were down to 5,600, right? And then in second quarter we jumped back to 6,200, and then third quarter we went to 66. Fourth quarter didn't do much, right? I think we peaked at around October somewhere, right? But didn't do much in fourth quarter, mostly sideways, right? So the returns were very lumpy. Even same is the case around the Nasdaq, right? April 11 was the lowest day for both, and Q4, like I said, was stagnant. 2025 performance, if you really look at it, even though we had a 17%, which is great, but if you go back to the history of the US markets, 98 years of the US market, 17% is right in the median, right in the middle, between 10 to 20%, right? So these are 10 to 20%, is right in the middle. That's where 17% is, let's say, which is, yeah, not greatest of the returns, not the worst of the cases as well, right? So we have almost 22 years out of 98 years where the market has returned between 10 to 20%, right? So, and it is ranked 45th out of 90 years, which is like not spectacular. This is what the market is on the center of the distribution, right? Average returns have been 11.85, close to 12%. Worst year was 1931, which was the market was down 44%. Median is 15%. We are pretty close to the median one. Best year was 1954, 52%. Right. 2025, yeah, so we already had a different chart from Bloomberg, but it was a year of rotation. We saw small cap, so-called value stock. They've lagged in 2020, in 21st century, but now we are seeing them outperforming the large caps. So from two angles, one is by the market cap. If you look at, the bottom 50% actually grew 33%. Means the smaller market cap companies actually outperformed S&P by almost double, right? Top 50% grew only 16%. Bottom 50% of the market cap companies grew almost 34%. Now looking to price to book value ratios, okay, I don't care about the market cap. I want to look at the value metrics, right? Classic value investing, want to look at a price to book value. If you dismantle everything and sell the assets at which they are priced at, that's your book value. How much the current market price is. I want to look at a price to book value. Lower it is, it is considered more value stock. So the bottom one, which is the lowest price to book value, means those are the value stocks, basically return 24%. And the top one returned close to what the S&P 500 returned. So in any case, we are seeing that there was a rotation in terms of the gains. It's not being driven by all the growth companies, because it's the non-growth companies or the smaller companies actually gained a lot more in their market cap versus the big companies, big growth companies. So the narrative is shifting. I was wrong. Only 2 of Max 7 beat S&P 500. There were questions around, oh, is the big tech on the top? Looking at the data, we didn't beat S&P 500. Right? So Max 7 totally added 5 trillion in market cap. And if you look at it, the ones that outperformed S&P was Nvidia, which was up 37%, 38% in 2025, and Alphabet or Google, which is up 63%. Everyone else underperformed S&P 500. So this actually goes against the popular narrative of all the market gains are driven by the Max 7. No, there are only 2 companies in Max 7. 5 companies actually underperformed plain S&P 500. And if you are holding individual companies, if you are holding Max 7, I hope you had either Nvidia or Alphabet. And this is the tricky point of investing in individual companies. Others are also great businesses. But you would have done much better by just holding S&P 500. Because in this case, your success rate is like 2 divided by 7, whatever that percentage comes out to be. Right? Your success rate wouldn't have been that great, like 30% success rate. When you're picking companies for Max 7, you have 30% success rate to beat S&P 500, right? I'm not even talking about QQQ. This is S&P 500. You can't even beat S&P 500. Let's look at other stuff.
I may have missed something, but are you saying that since 2024, the market has been kind of rotating into value stocks?
No, this is 2025 data.
So in the calendar year 2025, you're saying value outperformed growth?
In 2025 calendar year, yes. So bottom 50% of the market cap companies actually grew 33% by 33%.
So by market, you mean SPY or the VT, the entire US stock market?
This is, I think, S&P 500. No. So this one is actually gives you bottom 50% and top 50%.
Of the whole 5,000
of the overall markets in the
USA.
In US.
Okay.
Right.
Thanks.
Oh, so it was little surprising for me also to see these numbers, right? Then we talk about, are the stock expensive, right? And then Professor Damodaran basically had gone back and looked at through PE, which is your trailing PE, also looked at through normalized PE, which is, I'm going to take an average of last 10 years and normalize it. And then there was a KPE, which is Shiller PE, which means, hey, I also need to take account inflation and all that stuff. Yeah, sure. Market is expensive from any of these metrics. Whether you look at just a PE, which is what most of the financial media will talk about, that, oh, PE is expensive, right? We are looking at 37 PE, 25 PE. It's expensive. Or Shiller PE, it is 32, expensive. So from any of these metrics, this data goes from 1960. Yeah, we are. The question is, are we going to revert back to normal? I think there was a question earlier saying, was it here? Or I'm confusing with our discussion yesterday. I think maybe it was discussion yesterday during the networking after the pitch event. There was a question on, come on, the PE is super expensive. Which, yes, PE is expensive. I don't deny that. Should we now sell the stocks? Because it's so expensive? Right? While this seems to be a slam dunk argument, but if you really look at it, PE has been expensive since, I would say, if you look at this novel PE, it's been expensive since 2012 here. We had a few .com, but it's been expensive ever since. So we should have sold our positions way back. But then, you know what would have happened? We wouldn't have enjoyed all these gains. So maybe we have, and I think long back, I actually shared some data around, I think was it Michael Mauboussin's study, where we start to look at how the base PE itself is changing, right? We are willing to pay more for the companies now in the market because not just the earnings matter, but the quality of earnings also matter. So while the PE, only looking at the PE, that's a noisy and unreliable indicator. Again, these are Ashwath's words. Why you may want to look at it, why the high PE is. Let's look at the data that's behind the PE, which is our earnings. Now, if you really look at this, we're seeing S&P 500 over the last 25 years is up 420%. But the earnings have also grown 355%. Not that doesn't look to be too expensive. Not only that the earnings have grown, not only the fact that the US companies have become master in meeting these earnings expectations, not just meeting but growing these earning expectations. What we also seeing is that the consistency. Some of these companies have figured out whether it's a 2008 2009 crisis, whether it is 2018 bear market, whether it is 2022 bear market, whether it is COVID crash, whether it is Ukraine, whether it is blah 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 blah. They have figured out how to continuously make money. So then would you not be willing to pay higher price for companies or for the market in which companies have figured out how to just keep churning cash, keep making earnings? So I think except these three, one was the dot-com, great financial crisis, and probably the COVID, right? So these are the three where we saw some big dips in terms of the overall earnings of S&P 500. Otherwise, it's been consistently going up. The consistency have to have some premium. Right? So now if you look at these companies, not only they're growing their earnings, not only not only they're growing earnings, but they have also been very consistent. One thing that market dislike is surprises. So yeah, then I'll be willing to pay more for those companies who can consistently growing revenue. It's not lumpy. It's not, then it means it's not only dependent on external factors, because external factors keep on changing. We have seen so many things that have been changing ever since we've been talking about investing here. But it means the management have figured out some of these. The quality of the earnings also matter. The quality of these earnings is much better than the quality of the earnings that we may have had in the past in 1960s and 1970s. And then I'm not willing to pay you that same amount of multiple if you're not giving me the same quality of earnings. Now, not only these earnings can be, these are accounting earnings, right? So you could say, oh, you can create your numbers, but they have also been returning huge amount of a cash. This buyback story wasn't there in 1960s. We didn't have so many of a buybacks have been growing as a part of returning cash to shareholders. Buybacks have become more prominent part in last 15-20 years, right? From overall return cash return to shareholders. Obviously you can do through a dividend or through buyback. Look at the amount of the buybacks that the company have been using, right? So it means those earnings, not only that we have earnings which are growing, they're also consistent, and then there are also some real earnings because you're able to return more and more cash to your shareholders and using a more, I would say, a better method of returning cash, which is through buybacks. Because dividend, it becomes taxable at both ends. Buyback is much of a better way to return that cash, right? So why wouldn't I pay up for such market? So trying to compare with an average is very different. It's a lazy comparison because we're not even comparing apples to apples. The kind of a companies, the kind of a earnings, the consistency of the earnings, the kind of a cash that they return to shareholder, all those things have changed. And hence, we need to view in light of these additional pieces of information. That's not to say that 32 or 33 Schiller PE is cheap. Right? But it may not be in bubble. Right? You might be saying, oh, come on, it used to be 23, now it's 32. Yeah, but we're talking about completely different companies. Right? So then he talked about how do we know whether the market is overpriced or underpriced. It is based on, if you're investing in equities, how much of a premium are you willing to pay? Sorry, how much of a premium does invest in equities is priced in, right? Let's say if I'm only gonna get 4.5% based on the earnings in the cash flow, not based on the stock price. When you're looking at your equity risk premium, you look at based on the earnings of your company. This is the return on investment that this company is going to generate. If the return on investment is more than what I can get in a T-bill, the difference is called equity risk premium, because I'm taking a risk of investing in equity, and hence I need to have that premium. If the premium is only 1%, 2%, right, then it's not really worth. Then it means the market is in a bubble, because hey, come on, 1%, 2% of taking this risk, I might as well just buy T-bills and chill. Right? So you go back and look at your, if it does all that calculations. Currently, at the end of 2025, equity risk premium is sitting at 4.46%. Now you tell me, someone asks, is it a bubble? Is this equity risk premium too low? If you think 4.46% over the risk-free rate is too low, then the market is overpriced for you. If you think it is higher, because maybe you only started your investing journey when the market of the risk premium was very low, then it is underpriced for you. But if you think, I think this is a decent amount that I am okay to take the risk in equity, if I can get 4.5% premium more than the risk-free, then the market is rightly priced for you. So there is no one answer on, is the market overpriced? It depends on what you are looking to get out of the market. Right? So at the end of today, 2025, we are getting 4.46%. The companies are earning, S&P 500 collectively are earning 4.46% risk premium. Let's look at the historical risk premium. Right, going back to 1960s, right? Not that bad. This is again average, right? So basically he has categorized into different decades. So I went and I basically pulled out the base data, which Ashwath has on his, Professor Demoton has on his website. And then I computed these averages and median the quartile, because I wanted to look at the numbers, right? On an average, it's 4.25%. Then maybe we're a little overpriced, but we are not that, grossly overpriced. We're not in bubble. If you look at a median, same, right? Average or lowest one, which means the markets have been expensive. It means you are not getting paid enough because market is already expensive. It's like 2.53%. We are nowhere close to 2.53. And we are nowhere close to where the markets are the cheapest. We're nowhere close. So we are right in the middle. So while from all metrics perspective, we think OP is higher, it is because these companies are generating a lot more returns. The risk premium that we are paying at the end of 2025 is right where the average has been since 1960. Right? That doesn't seem that we are in a bubble category. We may be a little higher priced, but not in the bubble just yet, considering the earnings that these companies are able to generate. Now, We are in earnings season. We'll probably look at another 2, 3 quarters, maybe 1 year. We'll look for earnings, and we'll say, "Come on, the earnings have fallen through the roof, fallen through the, through the bottom because they invested so much on capex. Now that the earnings have all become negative, we can revisit then." Right now, as of end of 2025, I don't think the market professor doesn't think that the market is overpriced. So this also corroborates the other findings that I shared with you 2 weeks ago. It was a completely different study, right? Which also had a similar overtones of, hey, maybe we are overpriced, but we are nowhere as an overall market, we are nowhere near the bubble. We are not in the bubble category. So I thought I'll share, because this is a different way to look at from an equity risk premium perspective, which is purely based on how the earnings or the cash flows and all that stuff um, doesn't look to be that we are in a bubble, right? And basically then they forecast for next 5 years based on what analysts are thinking about. Then after 5 years, you just take the growth will be equal to T-bill. You want to get into Professor Damodaran shares all his information publicly. You can get into the details, but I really like it. I'm like,
Well, for your information, so in year 2000, Amazon was, of course, a loss-making company, had been for years. And this guy wrote a very big, like 100-page document which got publicized everywhere that, hey, Amazon is gonna be crashing and so on. So I don't think his investment record is as good as somebody said, like academicians are not the best investors.
yeah. So I'm not investing based on what he said. He also wrote a paper called Big Market Illusion, in which he talked about how some of the companies are thinking the advertising market is too big than what it turns out to be. It actually turns out to be that it was way bigger than what he thought. All I'm saying is whether the market is overpriced, underpriced is based on what you think. If you think 4.6% is good enough, historically, maybe then you have to decide if you want to
So,
sell or not, or what you want to do.
So there's another, so this is a way to look at a bubble based on static or cross-sectional analysis, or what you would have a MBA finance do. Now there's another way which has been done by people called Campbell Low McKinley, who are quantitative people. So what they do is they describe this bubbliness with respect to a time series. If price at t plus 1 is a formula based on PT plus something, then it shows bubbliness, then it makes sense. So in year 99 to 2000, when the NASDAQ ramped up 90% within a few months, now that's bubbliness. So that's a different perspective is looking at the time spectrum as opposed to the cross section.
Yeah. All right.
I can cite
Perfect
it.
segue. Perfect segue into my next point. Before you label me saying, okay, I'm only picking up the data which says that we are not in bubble, let's talk about some of the narrative. Okay, Ruchir Sharma. I think now he runs a Rockefeller Foundation. He's been a columnist for Financial Times. He wrote a book called Death of Capitalism. From his perspective, market is in bubble. Now let me give you his perspective.
The very title, Death of Capitalism, this guy is going to go down in infamy.
All right, so let me give you his perspective. So he has his 4 O's framework.
It should be Death of Socialism.
First is overvaluation. It says this occurs when the stock price disconnect from fundamentals like PE ratios. So while PE ratios might not always hit historic peaks, other things which are like price to sales, long-term average earnings, etc., price to long-term average earnings, if those hit peak, it means market's overvalued. One of the criteria for market in bubble, right? So then he came about, which is looking at last 10 years, right? 1970s, gold became 10x in whatever 6 years, then it crashed. That was a bubble. Then Japanese real estate became 10x, right? So overvaluation, major bubbles, price rise 10x in about 10 years. There's a different way of looking at it. I had no idea, right? 1990 NASDAQ, you just brought up, became 10x.
Right.
In 10-year crash. Commodities became 10x, then probably crash. I don't know. I don't follow
I think
commodities.
instead of looking at 10 years, you have to look at the last 1 year. For example, in this NASDAQ chart, last 1 year or 6 months, trailing 6 months.
So now it's like, hey, we have had a great run in tech, right? US tech companies. Now we are sitting at where it's overvalued. I don't think he's saying bubble just, but he's saying we are overvalued. But and in the past, all these overvaluations caused bubbles because the prices rose so high so soon. Second, O in his framework is over investment. Says hallmark of a bubble is a massive accelerated surge in capex. We saw that in, I only know about .com, huge capex in creating those broadband fiber, laying fiber cables that became then the dark network because there was no use of it. And then we had a lot of companies creating data centers, assuming, every capacity will be taken up. Eventually it happened, but then we had the whole accelerated pace of investment and not enough of demand and usage for it.
So what do you say to the fact that cloud, investing in cloud from year 2015 onwards, which I never saw, like why the stocks of Amazon and Microsoft were going up so much? That was also over investment in
Yeah,
cloud, right?
yeah,
But
so
it
let's go
hasn't
through this.
crashed.
No,
The
so
point
I'm
is that
not. So
it has to be looked at relative to the consumption of that demand as
yeah,
well.
we'll come to, because right now I think all the hyperscalers are saying we don't have enough of a supply. Not even talking about, it's not the same 2000 where we had dark fibers because no one using it. Right now the case is different, right? Which is, can you give me more? I need more. But I think we need to go one step further, is when that more thing that you're using is actually converting into profit. So, but let me go through his framework, Rich's framework. And we all know that all the GDP growth, right? The 40% of the economic growth in 2025 all came from the capex in AI, which is a huge investment in one theme for economy, which is as big as US, right? Third, it says it's over ownership in the stock market. Now American households hold over 52% of their financial wealth in stocks. We Americans hold more wealth in their stocks than in the real estate, which has never happened before. So he has a even chart for it. We are even more, only Americans own more wealth in stocks than in property. So it says 52%. Okay, financial wealth in stocks. So overall, if you look at, we have 32% in stocks, 30% in property. China, property high. Europe, India. Everyone is now playing in the stock market. Every kid is playing the stock market. I consider, let's say, poly market also part of that. Or if not stock market, then they are on poly market, right? Easy way to make money. Could that create bubbles because everyone now chasing it and bringing in capital into the stock market? It's a one way. I don't think any one factor is responsible for bubble. It's all the combined impact. Let's look at the last one, which is over leverage. Right? Is a rise in the debt to fund this hype. We haven't seen that just yet. Only we got a signs when the Meta and the oracles from that we have started to issue debt to raise funds, and Meta did SPV so that that doesn't shows up on their books. And you know what happened to Oracle? The CEOs against Oracle debt went up in price and the stock crashed because market was like, oh my god, we thought you guys was the cash flowing machines. Now you're raising debt to do these investments. We're getting little concerned. So, but Ruchir does agree that we haven't reached at this stage where the over leverage is a cause of concern just yet. But keep an eye on this one. Now we could be over leveraged. We could have over ownership. We could have over investment, and the stock could be overpriced, or the market could be overpriced, overvalued. all these things can continue for long until we get an increase in the rates. So the bubbles continue. Most again, this is his analysis. All the bubbles that got burst, the reason was because we started to get higher interest rates. I don't think we are looking at that right now. We are expecting that the Fed is going to cut the interest rate, right? Maybe this story will continue. But if the inflation start to raise its ugly head and Fed decide, come on, maybe we should raise it, be careful. Okay. And I know I don't talk a lot more about interest rates, but there are other more seasoned investors who say, hey, keep an eye on interest rates, right? Keep an eye on where the bond rates are going because that will shake the equity market. Looks like in the past that has happened. Okay. Again, different perspective. One perspective I gave you was from we don't seem to be in a bubble territory. Other perspective is we are probably in bubble, but it may not burst tomorrow. It may not burst for 6 months. It may not burst for next year. So we're kind of an investor like Stan Druckenmiller who will say, if I see a bubble forming, I want to run into it because I know it's going to expand. But then you need to also know when to get out of it. All right, I gave you two perspectives. Do what you want to, but it was an interesting viewpoints around what caused bubble, what burst bubble, and fact that are we in a bubble? Probably not. All right, there's another hand up. Go ahead, Sam.
So do you remember what happened when Microsoft started issuing bonds in 2009? At least this is what I remember of it.
I had no idea of the U.S. market. It just landed in U.S. in 2009.
Oh well,
You enlighten us. What happened?
they just said no problem. They don't have any debt, and the interest rates are low, so go for it. They had no negativity like you're talking about concerning Oracle.
Yeah, I mean, we have seen these companies issuing that. Like Apple issue a lot of debt, but then Apple is such a cash flow, and they can service the debt, and they're raising debt such a cheap interest rates, but not when the interest rates are 4%, 5%. I don't think Oracle is raising interest rates at 1%. Apple did it. So it's also raised at what price point you're raising, what interest rate you're raising it. On a zero in the ZERP era, all these cash flowing companies should be raising debt because hey, there's hardly any cost to raising the debt. And if you have enough of a recurring business, you have a good visibility to cash flow from a shareholder return perspective. Yeah, you should raise debt because it will increase your return on equity. Maybe Microsoft had done that. I don't know, but maybe in 2009. Yeah. So after a crash, the Fed would have gotten the interest rate down to zero. So, and if they had a good visibility into they have a recurring revenue stream. That is why most of these utility companies, telecom companies, see how much debt they have on their balance sheet. Like $150 billion, $200 billion debt on their balance sheet. But they have a customer base which will continue to pay their electricity bill and they will continue to service the debt. Long back, I think, was it John Malone who popularized this whole concept of taking a debt and juicing up returns, provided you have a continuous cash flow to service the debt. The problem comes in when you lever up, then you can't service.
So Vivek, in undergrad, we learned GM. Oh, so you know how old that is. GM was perfect that they were buying a lot of debt to service their thing. But I would never buy a company like that has so
But
much
what
premium
industry
power.
is GM in? What industry is GM in? Auto.
No, this was I learned it 40 years ago.
One of the worst industry in terms of generating returns. Airlines is another one. Maybe airlines is the worst. Auto is probably a number two. Right? It's a difficult industry. Heavy capex, no mode, difficult to make money. So if you are not I don't know. And because of heavy CapEx, they might have taken that. But anyway, anything else before we jump onto some other stuff? I want to share something, and I think we talked about it in this meeting, but I actioned on it. Was it this week or maybe no? I think I actioned on it this week. Then I tweeted about it. It's $1 million trade. Took me just 5 minutes to do this. Can anyone take wild guess of what it could be? Now you know me, how I invest or trade, what it could be. Did I find a great option? Probably not. No great tip, but all I did was switch from SPY to SPYM. That's all. And it was in my kid's account. And the reason I did was because I think in one of our meeting, right, I'm like, I did not know SPYM had an expense ratio of 0.02%. And I think in that meeting, and then we were comparing the results and the returns, and there was no convincing answer that any one of you could give me that what's the risk downside of picking SPYM. So you
So
did not.
I think somebody pointed out, Ramesh, that SPYM has a methodology called sampling to show you its value every time, whereas SPY does not. So that can make a difference.
But from return perspective, if we map up the return on Think or Swim, it's basically the same. SPYM versus
It
SPY.
look very, very same of, I mean, very close if you are taking it over a very long period of time, but in the short period of time, it could diverge.
Let me see. I mean, I looked at it that, oh, come on. Oh, here's a style. I never change these things.
So with sampling, they don't have to buy and sell stocks at all. They just sample. They have a list of programs that runs it.
No, but it's still the. Can someone explain the sampling?
I don't think we can. It's pretty
Okay,
detailed. Yeah,
maybe we should look at it. Let me. So this is
I
SPY,
think
right?
so. You know about these leveraged ETFs, right? 2x, 3x, etc.
Yeah, yeah, yeah.
How do they go out of whack if you hold them long term? They go out of whack for a certain reason, right? The same reason. They are constructed using sampling of underlyings.
Okay.
Like for example, if you wanted to buy UNG, you have to be very careful because you want to bet on natural gas is going up 50% in the last few weeks.
Yeah, natural gas has gone crazy.
Then you need to be aware of.
Yeah, I don't. Okay. No, this is acting wonky because I picked a 20-year period. Okay, so maybe I'll read more about it, but I don't think that they're doing sampling because I looked at his returns over last for exactly mapping what the SPY I mean. Now I'll have to figure out why they are able to give it as 0.02%. But that's different. I haven't done study. But anyway, I switched that in my kids account, and I'm looking at if you start with 28K investment, by the time kid turns 80, the difference between 0.7 basis points is actually $1 million. We don't think, and this is where, the compounding, that's why we call compounding is the eighth wonder, because 0.07% over long period actually makes $1 million of difference. And if we start with a 100K, 200K, the difference is going to be huge, way more than this is. I only started, I know, in my kids account with a 28K SPY. And then she had some Disney when I got her initiated into investing. Like, yeah, I loved watching Disney. I sold Disney and I'm like rationalizing the portfolio by only having ETFs. So I'm like, this is an easy peasy $1 million, extra $1 million of wealth. Why aren't we not looking at this? We were trying to find out the next hot shot and all the stuff, but if we can cut down our cost, over long period of time, the biggest difference is over long period of time. It makes these small fee makes a huge difference. That is why I'm very much against buying and holding these expensive ETFs or these exotic instruments which will allow you to get, you know, exposure to this or this buffer trades. And come on, they're charging you 250 basis points. You might think at 2.5%, it's okay. Oh no, do it over 40 years, you will see the difference. It makes tens of millions of dollars. Let's say you start with 100K, 200K. This 2%, 3% will make a few $1 million difference. You would have left all that money on the table. So, thought I'll share. This was revealing when you just 0.07%, how much difference can it make?
But there is one other thing that I want to talk about. The Node 2 instrument is going to do the same amount of returns over the same time period of 50 years. You might pay a little bit higher amount of fees, which might end up getting a higher return than the original one with the lowest price that you have. Vanguard has done that very efficiently. They are not doing over trading or anything. Their turnover is very low, and they have done that, and they have kept their words, and they have excelled in that. So that's one of the things. When you're trying to compare S&P 500 and SPYM, I don't have any idea, but it has shown, even though there is a 0.7% or point whatever 7 points,
7 basis points.
the difference, you have not seen any changes over the time period that you showed in your chart. So I cannot explain that, and I don't know if anybody can do that.
No, this is pre-fee, right? This is.
I just looked up. SPYM is essentially kind of trying to emphasize long-term buy and hold it investing, and what that means is you'll get a larger bid-ask spread if you were to use SPYM instead of SPY. And so if you understand that concept, then basically you can go for it. So in other words, don't trade with SPYM, but trade with SPY, like buy and sell frequently every few days. But on the other hand, to your point, Sri, Vanguard has essentially adopted the same approach as SPYM, and that's how they've got their kind of management fee for WU down so much, because they are emphasizing that aspect of long-term buy and hold.
Yeah, SPYM is not for institutions. SPYM is not for me because I trade options. That's why I've not changed in my own portfolio. I've done it for my kids, which, hey, you're not going to touch it for next 40, 50, 60 years. So let's keep it there.
But what about WU? Have you considered
WU is 0.03%.
There you go. So WU
it's more expensive than SPYM. It is more expensive than SPYM.
Yeah, that's true. Yeah. But I mean, I think Sri made a very good point. Basically, Vanguard is the company which recognizes this whole aspect that don't have too much trading, and that lowers costs over 30, 40 years. So first, this whole thing called WU was available only as a mutual fund. Then they became where ETFs are taking off, so they created a WU out of it. Yeah. But I think if you use the mutual fund in Vanguard, it'll give you even lower cost than WU.
Yeah, if there's something I can find it. There was another one.
Vanguard, S&P 500, institutional investor, or Admiral share, where they want you to park 50K at least.
So there is another one which is Fidelity has something which is got a 0%.
There you go.
But then you are tied with Fidelity. It's like a fund. It's not an ETF. So let's say if you're moving out of Fidelity, you'll have to sell your holdings. Right, but that's a specifically instrument created in Fidelity. So if some of you are in Fidelity and you want to get want to stay with Fidelity for life, I don't want any of that transferability. Fidelity has a fund which mimics S&P 500, but they do not use S&P 500 exactly. They don't have to pay the license fee to S&P 500 because they're not using their index, but they created their own, and hence they're able to offer it at almost no cost.
And again,
But then
These,
you can't transfer it to your other brokerage account because that exists only within Fidelity.
and again, some of these funds, they're doing options on the portfolio. They are making their own way of increasing or decreasing the expense ratio, and they're adjusting it. And I cannot really explain why some funds are doing better than the other one, even though they're all holding the same S&P 500 shares.
Mhm. All right. So that was and took me 5 minutes. What is a Fidelity symbol fund? Let's search for it. Fidelity 0 P S&P 500 fund. FNILX. F maybe Fidelity nil. FNI. Yeah. By the way, Fidelity has got another one which is 0.015. And FNILX is not exactly S&P 500, but it's a little broader because they can't use exactly the S&P methodology, but it little broader than that, but it's at a 0%. Anyway, let's look at the next one, Brexit. So Brex is a startup. They basically in 2021 they raised at $12.3 billion valuation, and now this week they sold it to Capital One at $15.5 billion deal. So the media and the Twitter and is blowing up saying, "Oh my God, they lost so much money." And I found someone who did a good deep dive into it. I found it interesting to read through it in terms of if you're a startup, and how these liquidation preferences work, and if you are planning to invest in a startup, you should understand these things. But here's a quick analysis put by Hari Raghavan, and the reason why I guess Brex sold it to themselves is they got their ass hammered by another company called Ramp, which is basically helping again corporates by giving them cards and managing their expenses, doing everything automated. My previous company, we were customers of Ramp, so I had access to a card issued by Ramp, and you spend anything, basically all those expense categorization management, it becomes pretty easy. So I guess ramped up much faster, and then the Brex is now looking for exit. So they sold at 5.15 billion, but everyone who joined and invested before 2018, pretty happy. Joe, those okay. Let me just bring that. Where is that stuff? Hey, where is that table I had? Which shows. Come on. Without table, it's not that. I had actually had a table of various funding rounds. I want to start with that so that you have that. We'll address next week. I don't know where. Maybe I missed out the table. But essentially, I think employees are still okay. If they had joined, except those employees who joined in 2021, 2020, other employees are okay. Even those who joined in 2022, but didn't immediately quit, they'll probably okay. Founders are doing great. And the people who lost money are the ones who invested, mostly institutional investors who added capital in 2021. But that's okay. That's a part of a game. Maybe we'll get into the detail next week. I'll have to find where the table is. What else happened? TikTok deal signed. Okay, so there's someone who shared the table. Let's bring that up. Thank you. And let me just take a screenshot of this and put in the document. Okay, now it will make more sense to look through this. So these are their funding rounds. Series A at 7 million, right now exited at 5.15 billion. Then Y Combinator, then Green Oaks, Kleiner Perkins did Series C at 2.6 billion, so on and so forth. Green Oaks TCV did at 12.3 billion, which probably maybe they've zero IRR. So anyone who invested joined in 2020 to 2021, they aren't happy. Those who joined late 2022, means after this, because the valuations had come down after 2022, and if you joined it after 2022 when the valuation depressed, you're probably still doing okay. So only think a fraction of employees who joined between the crazy days of 2021 and 2020, they are not doing good. Founders and employees doing pretty well. Founders maybe got close to $1 billion in total. Employees which are joined in 2023 and 25, they are roughly breaking even because their RSU is probably priced at $4 to $6 billion, which is where the company is. Joining in 2021, they didn't do well, especially those who left immediately, because those who stuck with it, companies do issue additional shares to plug the hole. But if you left the company, then you didn't do good. Okay. Joining 2020 did okay, but not commensurate with the risk that you have taken. Okay. Early employees did very well. Investors, D or D plus investors, which is these ones, Series D, and anyone beyond that, they didn't make any money, right? So from that perspective, maybe got back 0% IRR, because if your liquidation preference was 1, you will get back your money, but you didn't make anything. So if you invested in 2020, 2021, right? Hey, capital markets have been up, like QQQ has been up nice. You would have doubled your money. But in this case, you didn't do anything. Series C in 2020, again, did worse than suboptimal. IRR is 4%, whereas the market have returned much better, especially the tech market. Series C investors in 2018, 15% IRR. Right? I think maybe this is equivalent to what the market has returned. Right? Now, Series B, Series A, and YC, they made a killing. So all the stuff around, Series C, Series D, I want to get into, how can I invest in now this company? If you are in coming series, it's a difficult, right? Even these seasoned investors who invested in Series C, right? Lone Pile, DST Capital, Tiber Global, right? It's difficult. It all depends on what happens in the market. It's not a sure shot that everyone is going to make money. So, or if you make money, it'll probably not really worth, because you could have just invested in the public market and waited. You didn't have to take a risk on an individual company, whether it'll go IPO or not, whether it'll get covered over by or not. Then your liquidity is stuck. This is no premium for all those additional hassle that you have taken. And you've done, in case series, you have done worse than what the market could have done. Right? Yeah, but these made a killing. All right, what else? I'll skip TikTok. Only thing is, if you are Oracle investors, now Oracle is gonna get a data from TikTok. So I guess that's the only investing takeaway from TikTok would be. All other are the other funding companies are other PE firms. But Oracle will basically host all their data, and they'll do do the oversight of all the algorithms and all that stuff. Sector wise, energy is up.
Question, Vivek, before you go any further.
10. Yeah.
The Brex, whatever that that you're talking about, the company was valued at a particular level and then it came down, the valuation came down, and some investors lost money because of that? Or is
Yeah,
it
because
higher and
yeah,
then
it in 2020, 2021, every company was valued at a higher price because hey, market was in bubble and those investors who invested at that valuation, they didn't lose money because of a concept called liquidation preferences. They might have a, that if the company gets sold off, they'll get all their money back. They might have a kind of that liquidation preference, but they didn't make any money. They lost in comparison to they could have just invested in the market.
and the type of shares that they get are different from the original investors, and they have a different dilution factor, isn't it?
Oh, yeah. So that all happens on the negotiations, right? When you in a term sheet, when you negotiate as a founder and an investor, and that's the whole part of a negotiation is I want X liquidation preference, or I want to have a pro rata um, a preferable right to invest in if you're going to the next round of funding and all that. So there are a lot of these gets negotiated in the term sheet. So we're assuming because they didn't raise too much of equity funding. So assumption is, and I saw it on a multiple posts in Twitter is that the investors were not in a in such a great position to command, let's say 1.5x of liquidation. So assumption is they had the 1x liquidation preference means if a company gets sold off, first you have to pay me the amount of money that I've invested in. So the company got sold off for $5.15 billion. Then whatever they invested $300 million, they'll get the $300 million back. Assuming that all these investors has 1x liquidation preference, then you know what's left for the employees and other stuff. So that's how it is.
It's over my head. I don't think I want to
Well,
be
that's why I
involved
don't
in any of
invest
these things.
I mean, if you want to invest on a pre-IPO companies or you want to be an angel investor or like growth investor, you need to understand these things. They have a different, you need to understand how the term sheet is classified, who is on the cap table, what are the conditions of the cap table, and all this stuff, which is very different game.
And you, as an individual investor, you cannot negotiate anything. Whatever
No.
they throw at you, you have to pick up.
Well, first of all, you don't get access to these deals. You will only get access to these deals through some other instrument, which is going to charge you 3%, 4% fee anyway. And they may be able to negotiate. Who knows?
Yeah, I made that decision long time not to invest in any of these things.
So Vivek, have you ever invested in these pre-IPO type
No, I
companies?
told you you give me a capital big enough. I will invest if I have a capital big enough
No,
to
I heard that
invest
some people
in
like
50
put
companies.
$10,000 in some startup type
Yeah,
angel
but I will
investing.
invest 10,000. Yeah, first of all, I minimum want to invest is 10K because otherwise it won't move the needle. Number two, I want to invest in at least 50 companies. So unless I have a 500K of my overall portfolio, which I can earmark for startup investment, I think I will wait. Because the success rate in this startup investment is very low. I mean, you would know, right? 2%, 3%. We only hear about Facebooks of the world, Googles of the world. We don't know other 98 who went to the graveyard.
Right.
So I want to invest in 50 companies. If I have $10,000 invest in one company, my chance of success is 2%. I don't like those odds.
Great.
Vivek,
Yeah.
I hear that that the of the people who take care of TikTok, they got conned because actually there's been TikTok breakages since the last three 3 years that Chinese government has been monitoring. So it's kind of a
Maybe I don't.
US.
Yeah, once the politics gets involved in it, I have no idea what's happening on the back end. Right. Maybe you're
Yeah,
right.
well, I don't use TikTok, so I don't care. But I mean,
Yeah.
never deal with China on these things.
Yeah. I think Trump wanted to post a win, so he posted, "Hey, we have a deal now. Thank you, President Xi, for working with us." And yeah, he got his win. So one last point on this startup investing around. I do hold some companies in my portfolio which are like startup companies, which are like I classify it as a moonshot, right? But at least I have access to their finances. At least I can jump onto their conference calls and see what they do, what they not do. Yeah, I can scratch my startup investing itch by investing in those companies, and I keep it at a small part of my portfolio. All right, fear and greed index. We except cryptos is still in fear, and you will know why, because the Bitcoin hasn't done much. Stock buy or sell. I actually took a position in IGV. So the SaaS companies are given up for dead. And I was looking at, okay, Adobe, Salesforce, a bunch of these companies, ServiceNow, they're all trading at 30% down, 40% down, 60% down. Because our assumption is, with all these new AI and agentic AI, why would I pay license fee to Adobe? I mean, any company can create their own software, right? I'm a supermarket chain. I can use these LLMs. I can use this Claude code and create my own software. Why would I need to pay to Salesforce for the CRM? I mean, that's the narrative. And sometimes I think, again, it's not a big position. It's just a starter position. Sometimes I think we might have, pushed the narrative too far. It's like equivalent of assuming, what can I give? When the sewing machines came out, did all of us started sewing our clothes at home? No. Whom did the sewing machines help? It helped the tailors who were actually in the business already. I didn't start, hotel companies didn't start to sew the bed sheets or pillow covers or drapes, saying, now we got a sewing machine, why do we need to pay to a company that supplies us this? There are many inventions that we have seen that makes the job easier for the people who have already been there. And of course, it will give rise to new companies as well. Again, I thought I did not want to take a company specific position. Maybe Adobe will die, but I don't think all these companies will all die together and there will be completely new set of companies, or the existing companies, their customers suddenly will become so proficient that they want to develop software. Right? If I'm a retailer, my main job is not to develop software. Even though now I have tools to do it better, I will still want to have someone else do it. And those someone else can make use of these AI tools and give me much better, faster, quicker. So I thought maybe I'll start, nibbling because these stocks have been beaten to death. That's my reasoning behind taking a stake in IGV. I couldn't find any other ETF, and I didn't want to take a individual stock position. So if you look at Salesforce, right, 31% down. Adobe. And we've talked about these companies, right? You have asked me, is it a value play, value trap? I don't know. Only time will tell. But some part of a time, I think, hey, it's already, and they're good cash flow generating companies. So I took IGV, small position, starter position. We'll watch it. We'll watch the narrative in the market and then see. All right, what else? Earnings. Next week gonna be busy. We got a 4 of a Max 7 reporting earnings. And then the most important company in the world reporting earnings. So next Saturday, we'll spend some time on these earnings. Any other companies you are interested in? Oh, yeah, we have Apple, right? Yeah. I'm not interested in anything else. We got a Boeing reporting. Boeing stock has done well. So my retirement portfolio is a little happy. But let's see what it comes back with. Seagate, those who are invested in Seagate are pretty happy investors by now. Yep.
Have you looked at the financials underlying Seagate or SanDisk?
I just cursory look, I gave it, the margins are not that great, so I'm not doing Seagate or Western Digital, any of those. They are like a mid-teens operating margins. So you might have a growth, revenue growth.
Yeah,
I'll
I think
give you that.
you're right. They're running losses have been, but I think the projections on these, including Glassworks, which is Corning's GLW,
Mhm.
they've suddenly boomed, just
Yeah,
like
the boom
back in
is,
the fiber optic days.
yeah, the boom is in terms of, hey, there's a lot of demand for the storage, right? And hence we need a lot more storage, and
And
hence there.
optical fiber linking and stuff like that.
Yeah, and for Corning, it is the linking of the fiber optic cable. But the question is this: Are you, will you be able to extract some operating leverage out of that or not? Yeah, you made $500 extra in revenue, but what if you spend $500 in creating that revenue? It is zero left for me. As a shareholder, I get at the bottom line, right? No, top line is not for me. But there are in some businesses that you can get those scaling leverages. I'm really not sure if creating these hard drives is one of that business. So, and I went and looked at, like, say, last, Bill can do that again, right? And send is SDSK. What is SN?
SNDK.
Yeah. Okay, when I look at its margin profiles, right, I'm like, I don't know. It's been a mid single digits margin profile for the last 5-6 years.
Right.
It was I'm like, suddenly growing, giving you a lot more revenue doesn't really mean you're creating more value for shareholders. If you're not able to earn the return on capital, which is higher than the cost of capital, you're actually destroying value by growing the company. Then I would rather have you not grow your revenue. The more you grow revenue, more you're destroying shareholder value. I'm
So it
not
could be
saying
a
that
bubble.
SanDisk is at that level, but I didn't like its margin profile, and I ran it through my criteria of looking at, return on capital, margin profile, free cash flow generation, growth, how much of the reinvestment is required. I didn't like it as a business. I didn't like it as a great business. Stock has done great.
This could be a bubble stock for now.
I'm not gonna short it. I'm not gonna get in front of Reddit crowds. Okay.
Yeah.
I may be right, but I may still get bankrupt. So being right early is also being wrong, right? So I'm not
But
gonna.
it's good to make money every week selling puts.
Yeah, if you wanted to it. I've seen enough stocks gone through this. I have nothing to do. I didn't sell any puts. I'm not selling any calls. I'm just watching the fun from the sideline. And I think this, what's the Western Digital WD
WC. Yeah.
WDC? I when I last I looked at it again, look at this. They were like diluting shareholders like crazy.
So they spun off SanDisk just a year ago, and it's become like, I don't know, 30-fold or something like that. From $5, it gone to $360. How much is that?
Yeah. I don't know, guys. You want to play in this? Up to you. I'm not touching it. Again, if it is a good business and the bad stock, I will love that. It's a bad business, great stock, I want to stay away from it. And if it is a good business and a decent stock, yeah, I'll continue to build position on it. All right, last for this week's earning, we had Intel. Intel basically had a beat on revenue as well as adjusted EPS. Data center grew and the stock was down 17% because of this. They said we misjudged in terms of how much demand we will have our CPU, and we were not able to fulfill that demand. But this is the worst thing to have, is that you have a customer knocking at your door saying, give me this, and sorry, I don't have it. Right. And the other thing which was that there was no name, they didn't drop any name in terms of who is who is their customer for 14A new fab, right? And they're not gonna, I mean, if we don't announce a big customer, then the whole story of Intel is not gonna pan out. So their outlook was lower than expected, and that's why the stock was down 17%, right? Revenue projection was down, the lower than what the consensus. EPS wasn't lower than consensus, and I think gross margins were under pressure because of all this stuff. So didn't work out. And final one on the crypto. This is where the Bitcoin is. Actually, this was a GIF, so it was very funny to watch.
This is good.
It's stuck in this range. We're trying to get out of this range, but it ain't happening. Even for this week, we are sitting at what, 89K, right? I saw some news around that the Clarity Act, there's some traction that has happened on this in Congress. If we get that through, we'll probably see some life being breathed into crypto market again. Other than that, I don't think there was any other new update. No new update on any big protocol. I think Ethereum last upgrade was done for Saka. Nothing coming up on Bitcoin. I think there is a Coinbase has started initial discussion around quantum resistance for this, which will be good because that's one over, sword overhanging the Bitcoin is what happened to those 6 million addresses which we cannot secure if Bitcoin, sorry, not Bitcoin, quantum breaks the cryptography around it. So there is some discussion have started. Again, we are a few years away from it, but I think that's one area where some of the Bitcoin OGs have expressed concern, right? So that's it for today. All right, let me look at some comments. GLB up with AAPL glass. What is GLB?
I think he means GLW. Is that right?
Oh, that would have been then Conning.
Ramesh, is that what you meant?
Maybe it was GLW. Yeah, Conning. I remember GLW or Conning going up during Apple new iPhone coming up. It's gonna use Conning glasses, and then the Conning stock will go up. But now I think a fiber optic is the new Apple for them. All right, I will open up the breakout rooms and then I'll address some of the questions out here. I'll probably stay in lobby for some time, and then you guys can discuss all what you want on the breakout rooms like you always do. We can get to see some Jay's fancy charts. Is Jay still here? I don't say he brings up one of the best charts. Let me first open the breakout rooms because I will forget. So those who are new, so we have a few breakout rooms that if you want to talk about specific topics around swing trader, day traders, like I don't do that, but there are many folks who are fundamental investing, options, futures, newbies, and then alternatives.